Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey guys, welcome back to the Working Wealth Podcast. I'm Patrick.
And I'm Trevor.
And we are super grateful to have you joining us to talk about a really fun topic. Trevor, what we got today?
Yeah, this one's going to probably ruffle some feathers.
I hope so.
Yeah, I hope it does too. We are going to talk about the S&P 500 today, Patrick, and why it may or may not be a suitable long-term investment in a portfolio, especially in the context of it being the only investment in the portfolio.
Yeah. So give us some context. So what's the reason we're talking about this?
Yeah. So this is something we're hearing a lot. People are coming in and they're talking about the S&P 500. Well, first of all, what is the S&P 500? It is basically just the largest 500 U.S. companies that are publicly traded.
Yeah.
So
can we take one additional step back?
Yeah.
What is S&P?
Yeah. Standard & Poor is a company that has actually categorized and made indexes, made lists of companies that are used as baselines for the investment markets. So S&P, Standard & Poor, 500, it's just the top 500 companies. Basically, this company has made a list of the top 500 companies, and they use that as a benchmark or a trend line to kind of relate to the rest of the stock market, the rest of the global markets, and compare and contrast between that baseline.
Yeah, and they do more than just stocks, right? So it's like you have different like crediting agencies like Standard & Poor's, you got Moody's, you got other ones out there. But yeah, it's just like I think it's important to like have people understand it's not the end all be all. Like Standard & Poor's is literally just an organization that analyzes data essentially. So, but like it's the 500 largest U.S. companies in the index. An important note is it is whenever you get in index conversations, I think you have to again like make sure you understand what the heck you're talking about because you can build an index off of a lot of things. Yeah. I can make the Patrick Rogers stock index and like it could be whatever data that I want to look at to evaluate. And when we think about investing, you really need to understand what is the why behind what's going on. So like S&P 500 largest companies based on a market weighting. Yeah. So like it's a size weighted index. So the larger companies are going to be higher allocation to or like have a higher impact on what happens with the index overall versus you have other ones that are equal weighted or other types of weighting where like you could have just, for example, the S&P 500 equal weight, which is every company is 1/500th of the index. Like the performance of every company accounts for 1/500th versus you could have like the true S&P, almost 40% of the index is represented by 10 companies. So sorry, I cut you off.
No. This is really good, and I think like maybe just breaking down how these companies are actually categorized and sized because I think we hear the largest U.S. companies. What does that actually mean? Yeah. Well, when we say the largest, we're talking about their market value when it comes to their market capitalization or their market cap. You always hear that term thrown around. Really, market cap is just how many shares are publicly traded and what is the price of those shares. Yeah. You take those two numbers, you multiply them together, that gives you a number. And that's the market cap of any given company's stock. Yeah. So Nike has a market cap. Apple has a market cap.
I think it's pretty low compared to what it used to be now, but think their company. But
think of any publicly traded American company that you've heard of. Amazon has a market cap. They all have these different market caps. It's how many shares they have out in the ether. Yeah. At which price you take that number, you multiply it. That's their market cap.
And that's an important note too. I'm really glad you brought that up because we're talking about like essentially the 500 largest companies. Yep. So and over the past several years, you've had some companies drop out of the index. Get replaced by other ones. Yeah. there's a constant rotation inside of the index of like the biggest players might be the biggest players today, but if you look historically over the past decades, the top companies for each decade are almost never the same.
Yeah.
Now, we've had some consistent ones for the past 20, 25 years, but outside of that, like every 10 years, sometimes even every 5 years, you have almost a full turnover of who the top ones are. But like if you see things in the news where like people are saying, well, like Apple, I think was one of the first $1 trillion companies. Well, that's talking about their market cap.
Yeah,
the value of the share times shares.
So it's not actually like the revenue they're necessarily generating or the amount of money they currently hold. Yeah. It is literally just the market cap, the amount of stock, and what it's priced at out in the market that's available to trade.
Yeah.
So, really taking a look at that, when we talk about the 500 largest companies, it is by market cap.
Yeah.
Large cap companies, big, blue chip companies that we all think of, tech giants, things like that.
Yeah. Yeah.
And they're all compiled into this index, the S&P 500. And kind of getting back to like the original point of bringing this up, we have a lot of people, Patrick, that come into our office and they ask us about whether this is a viable investment type in that it's the entire thing that they put their money into.
Yeah, and I don't even think it's so much a question. It's like, well, I'm just investing in the S&P.
Yeah.
Like it's more of like a position of, I'm just going to say it, like, I was going to say arrogance, but confidence.
Yes.
They're like, oh, I'm going to be fine because I'm investing in the S&P. And like from an investment perspective, maybe like probably like if you're a good investor and you put all your money in that, in the same way of like if you're a good investor and you choose that real estate is your thing and like you put all your money into it, like like you're gonna make money if you're a good investor.
Yep.
But is that necessarily the best way to invest? That's where I think the question has to come into play of like, well, do you actually understand what you're investing in and like what all the options are? And are there other ways to do this? But I think we have been trained so much, like our generation is the S&P is the end all be all.
Yep.
I think Gen Z, you get like S&P plus NASDAQ.
Yep.
And then the generations before us was like the Dow Jones.
Yeah.
And you even look at like headlines today, Trump keeps saying, well, the Dow's going to hit 50,000. The Dow's going to hit 50,000. Well, that just shows you his generation, right?
Yep,
like,
exactly.
Like because the Dow Jones is just an index of, I believe it's still 38 stocks, right, of industrial companies that have been around for almost 100 years, right? The S&P been around for like effectively, I think the S&P has been around since the 70s officially. A lot of people will like project data based on the companies in the index going back further. But at the end of the day, it's kind of like measuring the temperature and like a weather report. Like it's just, hey, like, is it this or is it this? Which is like the index goes up and down based on the changes of values of the underlying companies throughout the day or on a daily basis.
Yeah. And I think like one of the reasons that we really wanted to talk about this today is because there's a lot of poor information out there, let's just say, about what you're actually getting when you're buying the S&P 500. I think a lot of people see it as a very well diversified investment type that I can buy one thing. It's simple. I've got my money spread across 500 different companies, which seems like it's very well diversified.
Sounds like a good idea.
Sounds like a really good idea. It's like, oh, I've got my money in 500 different big stocks, essentially. Great. That's awesome. I've got my money spread out. And I think we would counter and say, is that enough diversification, especially with how the S&P is actually tracked?
Yes.
And you were kind of getting into the way that it's weighted.
Yeah.
So, Patrick, if you don't mind kind of breaking that down and digging into that and how it actually is comprised, I think that might open people's eyes up a little bit to, okay, when I'm diversifying across 500 companies, what does that actually mean? Where's my dollar going when I invest into it?
And I'll start with just like the idea of diversification. I heard a very wise advisor say many years ago, diversification just means I'm always going to be saying sorry about something. I think that, and this kind of goes back to what I said in passing earlier, like if you are a good investor, it's never about having the best investment because there's nothing that is ever truly the best investment except building good behavioral patterns to be a good investor. Like that's the best investment you can ever like put your money toward, put your focus toward. But in terms of the actual investments, like being diversified means I'm always saying sorry for something, which is like also kind of the reason for indexing is like I'm not just betting my life on 3 or 4 companies that I'm hoping and wishing and thinking will do great. I'm spreading my money across a lot of things. I'm putting the peanut butter and jelly all the way across the bread, like to cover the ends, right? Dave Ramsey has a great quote, right? It's like diversification is just spreading it out, right? He talks about manure, right? If you keep all the manure in a pile in a field, it's just going to sit there and stink. But if you spread it out across the field and you fertilize the land, things will grow, right? So when we think about like the indexing, people think, like you said, like I'm buying the S&P, it's 500 companies, I'm going to be great. Well, there's some inherent lack of diversification in terms of the purpose or the function of why we diversify. So yes, functionally it's across 500 things, cool, great. But being the S&P 500, a market cap weighted index, roughly 40% as of today, like roughly 40% of the entire index's performance is influenced by the top 10 companies. You know, 2 years ago we talked about the Mag 7, the Magnificent 7. Now it's kind of like 10 companies, all of which are tech and AI focused companies. So you think about like
in one sector,
following a trendy trend. Not saying it's not going to pan out. Like it's done great for years, right? But you're going to feel the impact of small shifts much harder because everything is carried so heavily by just these 10. Not to mention it's only U.S. And I get the cases and I know the data of like international has trailed the U.S. a lot. But if you look at like an actual globally diversified portfolio of just stocks over the past 50, 60 years, if you don't have international exposure, your performance actually drags and lags just a U.S.-based portfolio over the past 50 to 60 years. I think very relevant recent examples of that is in the past 2 years, like 2024, 2025, even the start of 2026. If you didn't have exposure to international and emerging markets inside of your portfolio,
missing out on a lot.
You'd miss out on a lot. Like I believe last year, it's either 2025 or 2024, international and emerging markets were both up like 30+%.
I believe it was last year.
Okay. So, so like developed international, I think was up like 29-ish, 28, 29%. Emerging markets, 35 plus. U.S. was 18%.
Which is still incredible.
I'm not knocking it, right?
Compared to 35.
Right. It's
2x.
It's a very different scenario. Now, and I could also say, like, let's put the heckler on the side here. Well, emerging markets hasn't done well for 15 years. Okay, I get it. But there's been times that it has, right? And if you don't include that or if you don't account for a well-diversified portfolio across different parts of the markets, you're going to miss out, especially today because we're such a globally connected society. A lot of the products and services people buy today in the U.S. are owned or generated by international-based companies.
Absolutely.
So it's not like if you like candy, right? Guess what? Nestle is not a U.S. company, right?
Most of the cars on our roads today in America are not American.
They might have been assembled here, but like the actual company is not here, right? And it all goes back to like if a company is U.S. or global. It's based on the domicile of the headquarters, meaning like where is the headquarters located? Is it located in Europe? Is it located in Asia? Is it located in Australia? Like so on and so forth. But yes, like the key things that I would say are arguments for why the S&P is not diversified is first and foremost, it's all U.S. Secondly, it's market cap weighted index. So like you're heavy on the big hitters, which means the larger they are, the harder they fall, right? You can feel that a lot more, which I think beginning of this year with the whole oil issues with Iran, beginning of last year with the tariff situation, you have real recent examples of showing why just being in large cap U.S. doesn't necessarily make sense. So you have like the location piece, you have the market cap weighted piece, and then you also just have, I think in general, is like you're picking 500 companies. There's over 2,000 publicly traded companies in the U.S. Like you're also just picking this one sector. And we have a lot of evidence-based research over the past 50, 60 years that shows undervalued small companies actually provide you the best opportunity for long-term growth.
Because And I want to like dig into that a little bit more, Patrick, because that's a really profound
statement.
statement.
More research, but like
when you think about the essence of the big companies that make up the S&P 500, where did all those companies start? They started as small companies, as startups, as agile. Could be classified even as emerging companies or emerging market companies.
Yeah.
They just came out of creative, driven people that started small, started humbly, and then grew it into the behemoth that it is today.
Yeah.
So if you're not investing in smaller companies that have the potential to do the same, because that's one of the great things about the American markets and just the markets in general, so they're so robust. You're putting money in things that have potential to grow over time. And if you're just putting your money in things that are already massive, sure, they could also still grow, but you're missing out on a lot of the opportunity for those Apple stories, right? Of being invested in something like Apple.
Recently, the NVIDIA story.
NVIDIA,
right?
Yeah, exactly. I mean, you're missing out because NVIDIA wasn't part of the S&P 500 just a few years ago. I mean, it has just absolutely blown up.
Yeah.
And if you're just invested in the large companies already, you're missing out on the NVIDIA type growth and having money in companies that are smaller that are going to be in the S&P 500 down the road.
For compliance, could be
in the S&P 500. Yeah. I'm sorry, could be in the S&P 500 for the next couple of years.
And that's such a good point too. And I'll even relate that to like some investment theory. So a common theory in our world is the odd lot theory.
Yeah.
So like odd lot theory is this concept that small investors, meaning non-institutional investors, like non-institutional investors, typically the everyday investor like us, like you and me, right? Like the average person. They typically buy in odd lots. Now, what does that mean? Institutional investors typically buy stocks in blocks. Blocks are usually 100 shares or more, right? So people that are buying fewer than 100 shares at a time, technically called an odd lot. Again, typically your individual investor. Odd lot theory shows that historically, with a lot of certainty in this data and a lot of validity to this data, odd lot investors buy at the wrong time and sell at the wrong time almost every time, right? So what that means is if I am not an institutional investor, I'm typically buying based on feeling of like when it feels like the right time, or I'm selling when it feels like the right time. Like everything's so high, there's been a lot of growth. I feel like this is a great time to buy because everything's so high, like I have assurance it's going to keep going up. What typically happens, like when investor sentiment is really, really high, everyone feels really, really good, that's a very contrarian signal. That means I should be very cautious around what's going on, right? On the flip side, if everything is low, I just feel like, I need to cut my losses, I need to hedge my bets and like preserve what I have, I'm going to sell out. Also, like investor sentiment being low, like very contrarian, I should actually be thinking about holding on and doubling down on my investments.
And these are how the Warren Buffetts of the world invest. They know this, and they take advantage of things when people
it's not even taking advantage. It's just, it goes back to what I said earlier of like being a good investor, right? If I have conviction with what I'm purchasing, I'm making a good informed decision, which, again, not saying that just buying the S&P is a bad decision, but like I think in a lot of, the whole reason I brought this up, like in a lot of cases, this is classic odd lot theory. Like, what's the biggest? It's the most sure. Like, I feel safe with it. I'm going to buy this. I mean, if you're a good investor, it'll pan out. But your returns might be a little bit lower. Like, your results might not be as good over time as they could be if you were a little bit better diversified.
And I think, I think there's a lot of recency bias with the S&P 500 because it's been so productive the last decade or so, and
last 30 years.
I mean, even the last 30 years,
even like including the lost decade in the early 2000s. Like, just look at the numbers; it's still been.
You look at the historical returns. In the last 2 or 3 decades, the S&P 500 has been very, very, very solid to be in. However, it hasn't always been the number one thing in the market. It hasn't always performed the best. We've had years and 2 to 3 year stints where other things have actually outperformed it. And these are the things that people, they might shrug off and say, oh, well, it was 2 or 3 years. It's not that big of a deal. In investing, the big years and the big days are the ones that actually propel you the furthest when it comes to the long term. You're actually going to see the most growth when you're invested in things that really have a good year or a good day or a couple good days or a couple good years. And so having everything tied up in this one asset class, you're missing out on those other big swings where you could get potential growth that outperforms the thing that you're in.
Yeah.
So
I think a great recent example of that is the whole tariff trade last year. Yeah. Like when we had, I forget what they're calling the day, like Independence Day. Or,
Independence Day.
Or whatever it was.
Yeah. I think it was.
Independence Day is July 4th. Whatever the day was. You had a series of events in 1 week. It was specifically over like Thursday and Friday's trading days. The market declined by like 10.5%.
Yeah. And
I'm saying the market like the Dow, the S&P, like everything was down, right? And then you had the weekend to sit on it. And then Monday, it stayed there.
Yeah.
And then Tuesday, shot up 11.5%. Like almost everything was recovered right away, right? And that's one of those prime examples of like, if I made the wrong move and I got emotional and I just look at what happened and I think like, oh my gosh, I got to do something. If you sold out, like you would have missed.
Yeah.
You would have missed everything, right? And that's where like we was even talking with another advisor down in Florida earlier this week. He just met with a couple and they had a few different meetings talking through things. And one of the things that came up in the meeting was that the guy had been self-managing his 401k for 20 years.
Yeah.
And a question he had was, well, how do I know you're going to do better for me than what I can do myself? And I told him, I said, Hunter, like you just got to answer that question and say, hey, like I can't guarantee anything, but what I can tell you is, like after they had done some additional diving in to like understand his thinking and the why and all that kind of stuff, like the guy made some emotional, like pessimist-driven decisions because of the administration at the time. And he had moved half his 401k into like a stable value fund. And the other half was split between S&P, Dow Jones, Russell 1000. Or Russell 2000, it might have been, like small caps.
Yeah.
And I told Hunter, I said, like, in that situation, you got to have this conversation just very practically of like, hey, like let's pretend like you made a really good decision on getting out at the right time. That is not even half of market timing. What really matters is like, when did you get back in? And that's where the truth comes out.
Yeah.
The guy is still sitting after 18 years half in stable value.
Yep. It's a lot of missed opportunity.
Oh my God. Still sitting there.
A lot of missed opportunity.
Right. And we see this a lot of times. It's like we make this emotional decision of like, well, I need to hedge my bets and like preserve some of this.
Yep.
Compliance might get on me for saying this, like investing in stocks, if you're a good investor, might be one of the safest things you can ever do.
Yeah.
If you're a good investor, because of what it actually means, right? Like getting growth out of a diversified stock portfolio is I'm investing in the companies that we buy products and services from every single day.
Yep.
If you want to beat inflation, own the companies that create the inflation.
Yep.
Right? Like that's the only way you can really truly win in terms of like building and keeping pace and growing.
Yep.
I realize I'm getting probably way off track here, but like coming full circle to the S&P conversation is it's more than just owning like one ticker that comprises like 40% of it is 10 companies that have done well recently. It's what's happening within that. Yeah. And that's what I look at, even just on that one index. Like I like to look at the comparison of the S&P and the S&P equal weight.
Yeah.
And especially in the past couple of years, we've had a lot of scenarios, a lot of trading days where the equal weight does a lot better than the regular one.
Yeah.
Now, proportionally speaking, when the full index like does well, it's because those like top 10 or 20 companies like do really, really well. But don't forget about the other 490 companies.
Yeah.
And don't forget about the other several thousand companies globally that are also run by really smart people doing really hard work to maintain and grow their profitability by providing high quality products and services to the rest of the globe.
Yep.
Like if you say no to all of that, you're saying no to so much more opportunity by just trying to like keep it simple and buy one ticker of one index.
Yeah. And I think like a lot of people don't understand that when you're buying the S&P 500 index, you're not getting the equal weighted 500 companies. Yeah. You're not getting a dollar, on a $500 investment. I'm not putting $1 into each of the 500 companies.
Yeah.
I'm putting $490 into the top 10 companies, and then I'm spreading $10 across the rest of the 490 companies.
Yeah.
And so really it seems diversified, and it still is by definition diversified.
Yeah.
You're not in one thing.
You only need 16 stocks to achieve like statistical diversification.
Exactly.
Yeah.
But, is it as diversified as, I truly do have my money spread across 500 companies in mass? Mm-hmm. And I would say not always, especially if it's not a equal weighted index. Mm-hmm. So that's something to consider. Can it and is it part of a really successful portfolio mix? Absolutely. We've got a lot of people. We've got a lot of clients that are in S&P 500 funds, mm-hmm. and it can be a very healthy.
Like the weighting to those positions is part of a portfolio,
yep.
but it should not be, in our opinion, the end all be all.
Yeah, absolutely.
Yeah.
So that's definitely going to upset some people, but
that's fine. That's okay.
But I think
shoot me an email.
These are the important things that people don't know that they need to know when they're making these decisions.
Yeah, and I think like another key overarching theme with this line of thought is investment selection is not a financial plan.
Mm-hmm. Yeah,
it's not. I had this conversation with a client a few months ago where they maintain a separate brokerage account where it is just tech industry or tech sector stocks and ETFs. And we had this conversation past couple of years. We've talked about, hey, we need to diversify. Mm-hmm. We can manage that, take it over, get it invested properly. But recency bias has had a lot of success.
Yeah.
There's a lot of gains for these positions. And I just played out the scenario hey, you're 15 years from retirement. Let's pretend this continues to happen. Mm-hmm. What is the impact of this down the road? If that continues to happen at the same run rate, yeah, you're going to have a lot of gains, but tax sensitivity is one of your main concerns.
Yep.
When you have a lot of gains, what we're doing is we're promising ourselves we're going to have to pay more taxes down the road.
Yep.
So what is your strategy for us to strategically diversify and get out of this? It's I've never thought about that. Mm-hmm. I know, that's why we're doing the planning, right?
Yep.
And especially for this family, you make over $350,000 a year. You already have a lot of assets, a lot of pre-tax assets, which we talked about on prior episodes, the impact of that. We have to be thinking very critically around not just these short-term decisions we're making, trying to seek this dopamine hit of a really high return. Mm-hmm. Let's be more strategic and diversified, where we give ourselves options of how we do things in the future. But yeah, your investment strategy is not a financial plan.
Yeah.
And I want to apologize formally for everyone out there that our industry has sold you a bill of goods on that.
Yeah, absolutely.
Any advisor that's just talking about investments and just selling you on investment performance or they have the best strategy or whatever, they're giving you a flawed view of what financial planning actually is and what it should be, because we consider the holistic picture of your cash flow first and foremost, followed by your assets, followed by risk, followed by taxes, built on the foundation of legacy. Mm-hmm. That is what a good financial plan covers. Yep. It's not just the assets, because if you consider assets outside of taxes and outside of legacy, you could set yourself up for some really bad situations.
Yep.
If you also consider assets outside of cash flow, if I don't have the cash flow to put towards investments, well, I'll never be able to build wealth anyway, right? Or if I think about how do I use my assets to generate cash flow down the road? Well, how do I do that also in a tax-efficient way while not screwing up my legacy and also playing defense with the right risk strategies? Mm-hmm. You have to consider everything together.
Yeah.
I'll say our best clients are the ones that buy into that belief.
Yeah.
If we're just thinking about investments, that's not not how we operate. That's not how we can do our best work for people. But yeah, it's just thinking, well, hey, I'm going to buy the S&P, it'll get you somewhere. It'll get you a good starting point.
Yeah.
But I would not recommend that as your long-term plan for how you're going to successfully, accumulate wealth and then distribute that wealth for your needs.
Absolutely. And I think one of the pieces of the puzzle that we try to solve when it comes to the actual investment piece, obviously, there's a lot more to financial planning than just the investments. But inside of the actual investment sleeve, our goal as advisors is to try to lead people and guide people to make decisions that give them the best opportunities for the least amount of risk.
Yeah.
And that is a very fine line and
it's also not an annuity sales pitch.
Yeah, absolutely. Absolutely. But
much to your steak dinner chagrins.
But when you just objectively look at the S&P 500, is it going to actually help you in that it's the only thing that you're invested in? Is that going to give you the best opportunity for the least amount of risk? Mm-hmm. And I think we would both say probably not.
Yeah. Yeah. And just for reference, like if somebody's sitting here like, well, what do you actually look at? Mm-hmm. It depends, but primarily if we're thinking about the equity markets, like stock markets, like we're going to benchmark off the MSCI ACWI, mm-hmm. which is the Morgan Stanley Capital International All Country World Index. Like our portfolios that are all equity, they're benchmarked off of that. That's what we look at for a holistic, diversified approach, mm-hmm. because that accounts for U.S. and international of all capitalization sizes and also emerging markets. Yeah. Like that's what's going to give you the best picture of the global economy and what's happening there.
Mm-hmm. Yeah, absolutely.
So
anyway, hope people learned something today about why or why not the S&P 500 might be the best investment for your investment needs. But mm-hmm. Anything else to add, Patrick, that you can think of?
No, I just want to emphasize 2 points, which is like diversification does mean I'm always going to be saying sorry for something, which is also like inherently baked into like indexing in general. Is like if the 10 are doing great, that means the 490 are probably not doing great or not doing as great. But that diversification means saying I'm sorry, and then the other piece of just investments are not just investments are not a financial plan.
Massive point.
Yeah,
massive point.
But that's it. Yeah. But yeah, give us some feedback. Give us a like and a share. Yeah. Anything less than 5 stars, talk to me personally about it.
Give us your arguments for why you think the S&P 500 is the best thing and should be the only thing. We'd love to hear that as well, because we'd love to talk to you about that.
Yeah, that's a great idea. Yeah. All right. Well, cool. Well, thank you guys so much. We appreciate it, and we'll catch you next time. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.